Assalamu alaikum wa rahmatullahi wa barakatuh. I did have a slide deck to share with all of you today, but as you can see, there's not a whole lot of opportunity to project it. So we're gonna have to use our imagination a little bit as I go through some of the more complex parts of the structuring that is the core of what makes our program Shariah compliant. But to kick us off, so again, my name is Husam Qutub. I'm a Senior Vice President with Guidance Residential. I've been with the organization now since 2003, about 11 months after the organization actually launched, which was in April of 2002. And my presentation today is really to help everyone here understand a little bit about the history of the organization, what it took for Muslims to actually establish themselves in the US finance sector and establish themselves in an uncompromising way, because there were a lot of opportunities to take shortcuts. And what that history has taught all of us, not only about our organization, but the program and how it truly is riba free, but it also taught us to understand better our deen in relation to riba. You'll get an understanding of how the program is structured as well, to compare it to, for example, a mortgage loan. And then we can open up the Q&A later on to ask any more granular questions that you may have. So what I'm about to talk about is really, I think Amjad referred to it as an uncompromising path to Islamic home financing. I say uncompromising path because there were plenty of opportunities throughout the last 23 years to bend a little and give a little to appease Western economic principles, regulatory requirements, and push out a product for Muslims to use while we as an institution, to phrase it like some of the lawyers have told us in the past, we would be at ease. We would be able to save some money if we compromised a little bit. That never happened. Our organization was founded by a company called Capital Guidance. Capital Guidance, feel free to search them on your own, capitalguidance.com, is a 60-year-old, nearly 60-year-old private equity company, global private equity company that's owned and operated by Muslims. These were Muslim families who established this organization 6 decades ago for the sole purpose of essentially creating, establishing, and developing value-oriented companies around the world. That organization's global footprint today is in 27 countries, 77 offices. Our corporate headquarters for Capital Guidance is actually in Washington, D.C. Capital Guidance established Guidance Financial Group in the year 2000. And then subsequent to that, established Guidance Residential as a subsidiary of Guidance Financial Group in 2002. I know it's a little complicated as a parent and a grandparent, but the point of it all is this was an endeavor that actually took 3 years, a multi-million-dollar research and development budget by Capital Guidance, 18 law firms, not lawyers, but 18 law firms, prestigious law firms in US housing finance. And then most importantly, it entailed, at the time, 6 of the world's leading Islamic financial transaction law scholars. These scholars came from all over the world. The leading scholar in Islamic financial transaction law back then and today is none other than Sheikh Mufti Muhammad Taqi Uthmani from Pakistan. He leads also the Sharia board for the institution that provides standards to central banks around the world, Muslim central banks, It's an institution called IOFI, the Accounting and Auditing Organization for Islamic Financial Institutions. He and a group of other scholars in this discipline help create those standards for banks or Islamic banks in Muslim countries, central banks, financial institutions, to establish parameters that allow them to avoid riba at all cost. So it entailed 18 law firms, a Sharia supervisory board, an independent Sharia supervisory board made up of 6 scholars. The remainder of the scholars, they're all very renowned. They're from different countries like Saudi Arabia, Syria, here in the US, Malaysia, and other nations. This was an undertaking like no other. This was in 1999. And this undertaking took 3 years and a lot of work between the Sharia Supervisory Board members, the 18 different law firms, and our founder and the group of business professionals that worked around the clock to find a way to establish a non-bank or non-subsidiary to a bank solution for Muslims to own homes. And the result ultimately was a product, a program called the Declining Balance Co-Ownership Program. This program is completely different in the characterization and the establishment of the relationships between the financier and the consumer. Many have said there hasn't been such an innovative program in US housing finance in the last 40, 50 years. And it is unique because it does not utilize at all the lending method, which banking institutions live off of. Banking institutions essentially make their profits off of the lending agreement, whether it be lending you money at interest for a car loan, lending you money for a house, lending you money for a personal loan, a student loan, lending you money on a credit card for whatever you choose to spend it on. That's the heart of the US banking industry and the global banking industry, is the loan agreement. So we had to get away from that. We could not establish any lending practices whatsoever. The actual loan agreement could not exist. And we had to establish it through the use of a structure that is established under Islamic financial transaction laws. And there are a number of them, but one in which, when we went through the R&D project, was ultimately defined as the best path forward for this market. It's called the Musharaka Mutanaqqisa structure. There are other methods in Islamic financial transaction laws. There's a Murabaha structure that can be used, and it's used overseas a lot. There's an Ijara structure. The Ijara structure is a lease structure. It's no different than going to a car dealership and actually leasing a vehicle for 3 years. You're essentially signing an Ijara structured agreement. Murabaha is a buy and sell. It's if I bought, let's say, a computer or an asset, I refurbished it and resold it to you for a premium, and you paid it back on installments. That's a Murabaha. So both of the Murabaha structure and the Ijara structure were ruled out by our scholars, completely ruled out as instruments that may have some corruptibility in their application because of US constraints in the financial regulatory process. So they vetted these and ultimately landed on the Musharaka Mutanaqqisa structure. And I'm going to go into great detail about the Musharaka Mutanaqqisa structure in just a minute. But just to give you some background, this program of ours, established and launched ultimately in April of 2002, became something of a innovation sought after by other Muslims globally. So we became an organization all of a sudden that hit the radar of a lot of Muslim countries because of what we were able to do in the toughest, most highly regulated financial sector in the world. And it just so happens that our parent company, Guidance Financial Group, which was established in 2000 by Capital Guidance, became a global entity overnight and was called upon by the Kingdom of Saudi Arabia in 2005, 2006 to help it establish for Saudis a standalone mortgage company similar to what we accomplished 4 years prior. We did that. We were basically an investor, a co-investor, but most importantly, a technical advisor to helping them establish something akin to what we produced here. That company today, it's called Dar al-Tamlik, and it's the number 1 mortgage provider in the Kingdom of Saudi Arabia. Kingdom of Morocco approached us as well to help them convert their second largest conventional riba-based bank to an Islamic bank, which our parent company, Guidance Financial Group, along with our independent Shariah Supervisor Board, won that bid and actually helped them move along that process. Because of all of this, our parent company, Guidance Financial Group, established in Kuala Lumpur a sister company called Guidance Investments. Guidance Investments is more institutional investor, an investment solutions provider. And institutional finance is more for those who are looking to establish or invest tens, if not hundreds of millions of dollars in projects that are Sharia compliant. One that I'll share with you and then we'll move on is something that you all may be familiar with. If you've done Hajj or if you've done Umrah, in Saudi Arabia and Mecca and Medina, there's a hotel, and especially in Medina, it's right off of the Haram, called Shaza Hotels. And if you've seen Shaza Hotels, that exists today because of Guidance Financial Group. We established a hotel fund, a hospitality fund as they call it in institutional finance. That hospitality fund was structured in a way that would promote the building of a totally Sharia compliant Islamic style hotel with features that of course celebrate the Islamic tradition and so on and so forth. And it of course did not serve alcohol, does not serve pork, does not conduct its business in the way conventional hospitality does. And that fund, when launched, grew in popularity to the point where in our lifetime, we created this brand called Shaza. And in our lifetime, we partnered with the best hotelier business provider, solutions provider in the world, and launched these hotels. And now there are several in the Middle East growing into the European, Mediterranean area. So quite an impact just in the last 19 years. But let's get to essentially here, back in the United States. So today we actually have come a long way. We started with 3 states, we're in 34 states around the country. We've provided over $8 billion in this structured type of finance. We've helped over 30,000 American Muslims achieve home ownership and the investment in real estate. And throughout these years, we've received tremendous amount of exposure. Specifically, I would say most of it came after the mortgage crisis. If you all remember the mortgage crisis of 2007, 2008, because the Western press and others were very curious to know, how does an Islamic home financing company stay in business after a massive crisis in the housing industry? And to their surprise, we not only stayed in business, but we actually thrived because our structure prohibits us from taking on the kind of risk that banks can sometimes take on or push the envelope on. And that's because they have something that we don't. They have the ability to come after their customers and reclaim any possessions they have if they cannot repay the debt or repay the loan. So they push the envelope a little bit more because of their structures. We can't, we don't. Let's talk about the structures and the difference between them. I began talking about Musharaka Mutanaqqisa structure that our Sharia board selected for us to move forward with. And here's the main difference that a lot of us as Muslims probably don't understand about riba and how riba exists. Riba is an infringement on Allah's right, divine right, to create something from nothing. Riba is an accumulation of something from practically nothing. And the way it accumulates in finance is very simple. It's when the haves decide to use their capital to take advantage of the have-nots under the guise of, I'm going to loan them money, I'm going to help them. And through that lender agreement, a lot of problems arise. And if you think about what problems may exist through lending, it can come back to why lending is not meant as an instrument for investment or business. Lending is meant, under our deen, lending and borrowing is meant for charity. It's a charitable act. To lend money is to lend in Allah's name, to help those who are disparaged, those who are having financial hardship. And to do it properly, you must do it in a way where for every dollar you loan out, you can only collect the exact sum in return, so that you don't take advantage of those who are experiencing hardship. So the actual agreement of lending and borrowing, they call it the lender agreement. If you have ever taken on a mortgage in the US, you signed a lender agreement. There's a stack of documents that they give you. A lot of them are disclosures, but the core document is called the lender agreement. That's creation of the loan. That's essentially making you a borrower and making them the lender. And their reach from that point on is unlimited, because they gave you money, they sold you money, and they're creating from that simple relationship a lot of wealth for themselves. And when things go wrong and you cannot repay that debt, they can come, it's called recourse in the United States, they can have recourse over your other possessions. First, they can come and confiscate the house, of course, and sell it. But if the funds don't recuperate their loan amount, plus the interest on it, and perhaps the late fees on it, they can then come and issue a deficiency judgment through the courts to come after you for your other possessions, to liquidate them. And this can go on and on and on until they're made whole, plus their interest payments, plus their fees are made whole. What ends up happening, and why this is so corrosive to society, is this. As a lender, the odds are stacked against you, because ultimately they can chase you. And in history shows that it's lending and borrowing has led to injustices of all kinds. Lending and borrowing at interest has led to injustices of all kinds, including slavery. Because if you don't have any other possessions, what can a bank come after you for? Your labor. Slave labor. And this is corrosive. Beyond the fact that a bank is value neutral, they're value neutral. What that means is they would lend as long as it produces a result to anyone and anything and any cause without a barrier that states this is immoral and it's against our ethics. That doesn't exist. They'll finance liquor stores. They'll finance gun shops. They'll finance all kinds of things that are problematic for Muslims because it's good business. So for us, going back to what is the permissible structure that we have to follow as a non-bank entity, as not a subsidiary of a bank. We went through a rigorous process to deliver this structured program called the Musharaka Mutanaqqisa. And what this means is this. The Musharaka Mutanaqqisa structure comes from shirka, which is the word to describe partner. So shiraka, partnership. Shiraka can be looked at in two ways. There's shirakat al-aqd and shirakat al-milk. And most of us, as Muslims, as citizens of the world, we know shirakat al-aqd more than we know anything else. And shirakat al-aqd, just to describe it plainly, is a partnership with two parties or more over a venture, establishment of a venture. Now I'm going to stop for a second. Housing is not a venture, right? Housing is an investment, but it's not a venture. A venture is a hotel, a gas station, a restaurant. That's a venture. So Shirakat al-Aqd is one that most of us know, have heard of, and it's very simple. You come in 50%, I come in 50%, we buy this restaurant, we fix it up, we make sure it functions the way we want. There's expenses that are shared 50-50, and there are revenues that are shared 50-50, and ultimately profits 50-50. Pretty simple. It doesn't have a timeline on it. If it's succeeding, we continue. That's Shirakat al-Aqd. And I want to make it clear because this is the confusion. Shirakat al-Aqd is not the contract or the structure that our Sharia Supervisory Board advised us to move towards. They advised us on a different path called Shirakat al-Milk, joint ownership. That's what Shirakat al-Milk means. So joint ownership of an asset. And there's two types. There's the compulsory that we will all face at some point if we have parents who own assets and they, God forbid, they pass away early, you and your siblings will all of a sudden be in partnership over the ownership of perhaps their home. And you'll have to decide at that point. Does one party want to live in it? Does one party want to liquidate it? And you have to decide on a way out of Shirakat al-Milk. So our Shirakat al-Milk establishes joint ownership of an asset with the understanding that one party, the financier, does not want to be co-owners with you for life. The co-owner, Guidance Residential, wants you to buy them out. So there is an acquisition track that you choose as a consumer, either a 30-year acquisition track, a 20-year or 15-year acquisition track. And at any time, you may buy the shares of your partner outright with no penalties. So there's one monthly payment, and it contains two components in this arrangement. The monthly payment is the result of a acquisition payment or acquisition portion of the payment. You're acquiring. Every month you're acquiring our share. But every month you're also utilizing, and you've been given exclusive use and enjoyment of the entire property, including the portion you don't yet own. So let's, in a simple example, $100,000, you bring $10,000 to the transaction, we bring 90. We actually buy the property together as co-owners. We create an LLC for that partnership to limit the liabilities in case things should go wrong on your end and things should go wrong on our end. And a simple example of that is a lawsuit brought onto us should not be able to pull our partners into that lawsuit and vice versa. That LLC creates that structure. That's why it's so important. From there on out, the agreement is about an obligation to buy us out. And in that agreement, we're looking at your 10% versus our 90 and a shift for you to increase your ownership and a shift for us to decrease our ownership. But during that process, you're given exclusive use and enjoyment of the home. So we don't prevent you from, living upstairs in one of the bedrooms and not touching the other levels of the house. You get to use the whole house. But we will charge, and we have the right to charge you for usage. We call it utilization. Utilization of the portion of the property that you don't yet own. And that's where profit is allowable. That's how our profit is allowable. That's how our ability to actually make money in facilitating homeownership in the United States is possible, because it's tied to that use. And every single month, your utilization amount decreases, because every single month, you're actually buying more and we're owning less. So there's actually a trade-off that happens in your monthly payment each month. That's an important distinction because, and I'll say it very clearly, when things go wrong in this arrangement, our consumers are more protected than when things go wrong with a traditional bank. And I'm going to go over those very quickly. Number one, we have a non-recourse commitment. I touched upon it earlier. So in case of default, we would look at a way to reconcile this so that we can keep you in the home. But if you can't make your payments, and after we go through plans to remediate, and we ultimately end up at, this is not working, we want to sell the asset between us. We need to liquidate it. And in that process of liquidation, if the funds come back and they're higher, you take all the upside. Our consumers make all the gains on equity increases in the property. So appreciation goes back to the consumer. If the opposite happens and we sell the house for, let's say, $70,000 and we had 90% ownership of a $100,000 house at 90-10, we take a loss. So we would end up taking a $20,000 loss and our consumers take a $10,000 loss due to our consumers not being able to meet their obligations. In a different scenario, something outside of our control, natural disaster and eminent domain, where you're forced from the property. The proceeds that come back from insurance or local government, if they're below what we originally paid for the house, we actually share in those losses equal to our ownership. You won't find that anywhere else. We actually went through this in Houston when hurricane hit Houston and a lot of our customers ended up losing their homes. We took losses alongside with them. There's no prepayment penalties. There's also a capped late payment fee. If somebody's late, we only charge what it costs to remind them, administrative costs, and it's capped at that level. I'm gonna stop here because I know that I'm running out of time and I wanna allow for my other panelists here, Amjad, to come speak to you about investments. I will say that we've achieved a lot of greatness in the last 20 years, alhamdulillah. In 2014, we received the endorsement or the support of AMJA, the Assembly of Muslim Jurists of North America, after many years of them trying to understand our structure and working with us, ultimately working with one of our Shariah Supervisory Board members to learn and understand the complexity that it took. And alhamdulillah, we became essentially, in their eyes, the most permissible path to Islamic home finance for American Muslims. Other endorsements are all around the country, but I'm gonna stop here, and any gaps that may be created by what I just said, we'll try to answer them during question and answer. At this point, I wanna invite Amjad up to the stage.